I'm going to go ahead and get it kicked off. Hi, good morning, good afternoon. My name is Devin McCarthy, and on behalf of Nasdaq, ISS Media, and Blackrock, we're thrilled to be here with you today. As many of you know, this webinar today is part of an ISS Media educational series to create long-term growth for the 529 industry. We've split today's webinar into 3 discrete sections. The first is going to be around the 2020 impact on the 529 industry. The second part, how advisors are adapting to the changing industry landscape. And number 3, how Nasdaq is driving transparency in the 529 space. Throughout today's webinar, we encourage you to ask questions via the chat box below. Additionally, we will be polling the audience throughout our session, so please take the time to answer the questions. Finally, we will be using the sidebar on your screen for some handouts we will be sharing as well too. Like I said, my name is Devin McCarthy. I've been with Nasdaq for 11 years. I manage the Nasdaq Fund Network sales and partnership efforts. Tarun?
Hello, everyone. My name is Tarun Garg, and I lead Blackrock's college savings business.
And I'm Paul Curley, Director of Savings Research at ISS Market Intelligence, where I oversee data research events and digital as it relates to 529 plans and able accounts. And for Devin, being relatively new to the 529 industry, I did want to note one thing to point out. So I in a previous role, I was with Investors Bank and Trust as a custody fund accountant. I was on target for quality. And one of my bullet points for my role was meet corporate goals for NASDAQ accuracy and timeliness, 99.9% ultimate goal of 100%. So I've known NASDAQ overall since 2001 and look forward to learning more. It was a great opportunity, and we appreciate your time and effort here today, NASDAQ and Blackrock.
Awesome. I appreciate that, Paul and Tarun. Thank you. Before we get started, we wanted to take a quick poll just to identify your relationship, the attendees' relationship to the 529 market. Please take a moment to respond to the survey. I'll give you 15 to 20 seconds.
Numbers are still jumping around, Devin. I like it.
Yeah.
We'll give it another 5 more seconds and then start to read it off.
Paul, I'll let you read it off if you don't mind.
Yeah, sure. Sounds great. So there's 37% of today's attendees are within the state category, and 24% are within the product provider and distributor category. 17% in the broker dealer, financial advisor category, and about 22% in that other category. Lo and behold, Devin, it's a great opportunity to kind of take a look at the broader 529 industry. All the different components work very closely together. So with that, hopefully the audience helps us to go through today's sections. And with that, back to you, Devin.
Yeah, appreciate it, Paul. So before we get into it today, I just wanted to speak a little bit about NASDAQ and our overall business. Many people associate NASDAQ as a stock exchange or a listing venue for U.S. equities, and we do run and operate both of those industries. But NASDAQ is so much more than a stock exchange. We're a global technology company servicing the capital markets. We own and operate 26 different marketplaces worldwide, 9 here in the U.S. alone. In our market technology segment, we take our own exchange technology and license that to other marketplaces. We power over 130 global markets. In addition, we have over 165 broker dealers who use our technology to monitor their trading activity. Separately, in our index business, for instance, NASDAQ calculates over 40,000 indexes covering equities, fixed income, commodities, options, and multi-asset solutions. Our global equity index benchmark includes approximately 9,000 securities from developed and emerging markets. As of the end of January this year, there are over 330 exchange-traded products with over $360 billion in assets tracking NASDAQ indexes globally. At NASDAQ's core, our goal is to provide transparency and market stability to the asset classes that we serve. For the audience here today, the topic we will be discussing is the transparency and trends in the 529 college savings space. The Nasdaq Fund Network is one of Nasdaq's longest standing products and services. Originally founded in 1985, the mission of the Nasdaq Fund Network has always been to provide ticker and price transparency for mutual funds for both institutional and retail investors. Nasdaq is the single venue for the 5-character ticker symbol, assigned to 99.9% of U.S. listed mutual funds. Today we have close to 600 529 QSIPs registered with searchable ticker symbols. Most recently, we partnered with Blackrock to register their Ohio State College Savings Plan, and more on that to come between Tarun and I later on in the webinar. Many of the trends, both on the issuer and advisor side, will be discussed here today. And finally, as discussed earlier, there will be time for questions at the end of our webinar. If you can direct those to the chat below, that would be great. So let's go ahead and get into it. Paul and Tarun, I'm really excited to get into today's content. So let's go ahead and jump in. Paul, from 2020 was obviously an unprecedented year in pretty much every single capacity, both personally and professionally for most people. So how was 2020 from a 529 perspective? Were there new account holders, assets increasing, decreasing? Can you speak to that?
Great question, and thank you so much, Devin. First and foremost, one thing that I always kind of say is the importance of saving and saving efficiently. And this first slide looks at the overall savings rate. How many people, what percentage of the income for families is being saved? What was very intriguing for the longest time, was that this overall decreasing savings rate overall. We saw that historically speaking, it had even hit 15%, as a percentage of U.S. savings rate, and that was probably in the 1970s, right? And once we saw that early 1980s, it went from that 15% level to that 10%. We kept hovering lower and lower to that, definitely sub 5%, savings percent level in the more recent history. What we saw in 2020 was that huge surge, that overall, increase in overall savings rate, which, by and large was a great trend. Reaching record levels. This chart here goes all the way back to 1959 from the Bureau of Economic Analysis. So it's great to see that 2020 resulted in that increase in overall savings rate. And that was one of the great starting points to people are saving. Now let's talk about saving efficiently. And what we saw was that overall increase resulting in more people saving for college with 529 plans. In 2020, we saw a 15% increase in assets, which was a great surge. By and large, and just as a quick reminder, folks, the change and increase in assets is two things. And this even goes all the way back to my days at FRC, Financial Research Corporation. So the change in assets is really boils down to two things. One is performance, and the other is net flows. Of course, the performance is pretty easy to explain, like what was the performance for the funds. And of course, Devin, your team knows all very well about the side of the performance. And so it's great to have the partnership here today, so you can kind of get that message out there about the performance and transparency, but that net sales as defined as gross contributions, money coming in, minus gross distributions, money going out. So that spread widens. There's money coming in, broadly speaking. It was even nice to kind of work on this presentation because even, for me, I started, 529s in 2010. So we're at that was sort of like the mid-year point in this chart. So, by and large, it was great to see the, assets increase and that performance S&P 500, just as a number being thrown out there was an increase of 15%. What was one of the main drivers for that net sales was more families, saving. Like the number of accounts opened, basically reached 14.9 million as of, probably today. We've beat that 15, million number of account benchmark. But of course, as we know, that there's multiple accounts, 529 accounts per beneficiary, or multiple accounts per household. So we've seen that, basically that the number of households using 529 plans, went above for the first time that at 10 million. So assets are increasing, number of accounts are increasing, reaching all-time highs, which is great news. And by and large, we've also saw in 2020 an increase in gross contributions. There was a lot of money sitting on the sidelines that probably, by way of that surge of stimulus, but also just people not being able to spend money, right? Not being able to travel, go out to eat, and all these other items. So, people saving, backfilling their emergency funds, and all of a sudden saying, hey, what goals should I be saving for? And one of that being, as we can see in the data and the trends, being 529 plans. Inversely, one intriguing trend we also saw was that decrease in gross distributions. More likely than not, just people taking the gap years, just deciding, hey, like, let's just wait for 1 year to go back to college, therefore take that distribution. So that was that widening, if you will, of the gap between gross sales, gross distributions, and that taken together, that increase in gross sales, in net flows, I should say.
Good stuff. No, that's really insightful, and great to see that both men and women are saving for their kids' college. So many economists like to compare 2020 to 2008, given some metrics such as massive unemployment and GDP comparisons. Do you see any parallels in the 529 space between what happened in 2008 versus last year in 2020?
Yeah, I mean, and luckily, or perhaps even surprisingly, the storyboards are basically the flip opposite. In 2020, we saw the increase in assets. In 2008, there was that rapid, decline in net flows, as indicated by, just a decrease in performance, market investment performance, but also a slowing of the number of new accounts. The new accounts remained positive, though it did slow down. The other item that's very intriguing in 2008, and this is something that I said maybe 100+ times, during that era, the net flows in 529s remained positive in 2008. Again, the net flows were positive. There was a lot of different investment products that were just hemorrhaging money, meaning gross contributions was vastly outstripping the gross distributions. What we saw in 529s was the gross sales decreased. We also saw an increase in gross distributions taking place in 2008. So, very different storyboards, the 2008 scenario versus the 2020. And vaguely speaking, even that scenario was, the crux and the silver lining being that it was still positive. So we see that green piece of that green bar there showing how wide it was before 2008 and 2007. We saw that the tightening of the net flows in 2008. So. But that's what I see from the numbers, and it'd be great to see what Tarun has to say from his perspective on this very topic as well. So thank you, Tarun.
Yeah, no, thank you, Paul. Maybe I'll just go back to the premise of the question. For many of us, the economy feels quite good these days. So a comparison with 2008 may actually seem far-fetched. But if I could briefly take everyone back to April of last year, in a span of about 6 weeks, the US unemployment rate went from less than 4% to 14%. The economy lost all jobs created since 2008 and more, and the markets were down 30%. At the moment, it totally felt like 2008 or even worse. Now, the massive stimulus provided by the governments around the world, the biggest one being the US government, really saved the economy. And it led to that spike in savings rate we saw in Paul's first chart. Now, the politicians get a lot of flack generally, but I think the government really came through on this one. As a 529 plan, we have been a beneficiary. Just like Paul mentioned, for the overall industry, it was a good year for us. 2020 was a good year for us in terms of new account creation and contributions. In fact, it was one of the best years on record. Back to you, Devin.
And I'll add on to that one, Tarun, and also to say it was very intriguing to see how in the UK the GDP decreased 9.9% in the UK, where in the US it was a decrease of 5%. And that difference of 5% was an example of that government stimulus that was additional in the US versus the UK. But sorry for jumping in, but back to you, Devin.
I think that's an important point and really good sound bites. So I know from an exchange perspective, we saw many different changes in the market last year and even into this year, from unprecedented market volatility to an increase in new retail participants into the market. According to publicly available data, in fact, Q4 of 2019 compared to Q4 2020, the exchanges in general saw an 80% increase in retail participation, up from 8 million retail participants to close to 15 million. Paul, from from a 529 perspective, did you see an increase in participation as well from the data that you've collected?
Yeah, we do a lot of data research that looks at how do you get non-savers to become savers, savers to 529 users, and 529 users to power users, right? And by and large, based off of our survey, was that there's a lot of interest and demand in 529 plans. Just due to the expansion of qualified distributions from primarily college to K through 12 to student loans and all these different and apprenticeships. So it's just sort of like that. 529 is being used as, hey, how do you save and pay for college to a much more broader set of deliverable, qualified distributions from that perspective. And obviously aligning with the comments around the unemployment rates, there's also that refocus on how do we retrain and get people retooled, for the economy for the next 5 years and going forward. And obviously 529 has a great opportunity for those that are looking to do mid-career changes, mid-career shifts, perhaps someone getting an MBA at Villanova, Devin. So there's a lot of different ways to just sort of like more usage and supercharging of the usage and therefore demographics as well. But Tarun, from your perspective,
I would just underscore 2 data points, Paul, that you shared a little while before, actually, that in 2020 more families opened a new 529 account than ever before. And by the end of the year, more families had a 529 account than ever before. I think you mentioned 15 million accounts, almost a total of 15 million accounts. And as a 529 industry, I think we sometimes get mislabeled as a tax planning vehicle for the wealthy. So it's very encouraging for me to see that all of us collectively, we're going broader, and that the average account size that open is also getting smaller. And I think that's a very positive development for all of us.
I couldn't agree more with you, Tarun. I mean, I think we see a total parallel between retail participation in the market over the course of the last year and participation in 529s, which I think is great for all investors. I think it's hard to argue that point. So I'm going to go back to you, Paul. Can you touch upon any other broader 529 trends, be that fee pressure, technology enhancements, regulatory changes in the industry that perhaps continued in 2020 into 2021?
Yep. And Devin, we make every effort to make sure we make the listeners feel like it's a live question and answer. So Gina, we will follow up after this presentation. The follow-up email will have the contact information, and feel free to ask us for the decks, and we're happy to share after. So keep the questions coming in. Yeah, so in terms of newer trends, newer themes, obviously the college financial planning employer benefits, being a top related one, with the CARES Act, the student loan repayment by the employer is now a tax advantaged capability for the next 5 years. So that, broadly speaking, has increased the focus of 529s and college financial planning employer benefits within the employer channel. We also saw over time that those fees continue to go down and down and down. We saw in 2008 a real big focus on fees, and that kind of trend and focus hasn't slowed down. We also saw data and technology, being a newer component. We recently saw Census, for example, launch their mobile app. So timely question, Gina. So thank you for the highlight in the note, but also congrats and kudos to just making it easier for the direct consumers, just ease of use and getting the message out there. But touching upon that advisor sold channel, just more and more focus and around the fee-based share classes. There's more advisory share classes out in the marketplace, but those are a lot of smaller snippet concepts. But Tarun, you always do a great job of providing a great bigger picture context. So over to you.
Thank you, Paul. And I'm going to actually take your big picture and make it a smaller picture. But the one comment that you made, Paul, about ease of use, I just want to spend a couple of minutes on that trend, mostly from an advisor sold channel perspective. And when you look at surveys, and Paul, you've done surveys that are your numbers. I sometimes look at the Edward Jones survey, or a Sally Mae did one survey a couple of years ago. All of these surveys, they report very similar numbers, which is that about half of American families save for college. Now, that's understandable because if you don't have money, you cannot save. And that's probably a public policy problem, which I'm not sure that our industry can do much to solve. But then the next statistic is even more stark. Of the families that do save for their kids' education, only about a third use a 5 to 9 account. And to me, that is almost unforgivable because 5 to 9s are just a much better vehicle for most families, even if not for everyone. That's a big miss for all of us. I think the solution lies in more awareness and education, pun intended. And I think that the financial advisors are a key component of the solution. There's about 350,000 of them, and we know that many of them do not talk about 5 to 9s because the old-fashioned paperwork is just too much trouble. So that is something that we as BlackRock, and I know many of our partners and peers, we continue to focus on and make progress on. So that's what I wanted to say on that one trend. But with that, Devin, back to you.
That's great. That's great. It's really insightful. Thanks, Tarun. So switching gears here just a little bit, Paul, I know you recently rolled out a new advisor survey poll. What were some of the key results? More importantly, what are you hearing from advisors?
Yep, great question, Devin. One of the interesting things is that you'll notice that I bounce around quite a bit. But I'll just take the question from Joseph. Does the data suggest that the investor base in 5 to 9s is less sensitive to market economic volatility than other segments in the market? My quick response is yes. It's a longer term investment, and people are automatically contributing it, making contributions from the employer channel. But the other intriguing thing that happened in 2020 was the ability to, if a family had an immediate liquidity need, they could take up to $100,000 distribution from their 401k. So I think that 401k option provided some liquidity from that volatility. Before I actually go back to the question, Tarun, do you want to add on any color to that one, or?
Look, I mean, I actually don't have the data in front of me, Paul, but this is a question that we sometimes think about internally at BlackRock too, which is, I'm looking at Joseph's question and exactly that, which is the investor base in 5 to 9s less sensitive to market volatility than other segments of the market? And I think generally speaking, when we talk about flows from a BlackRock, from an asset management perspective, it is an argument that we use internally, which is if you look at the flows inside of your 5 to 9 account versus say even a retirement account and definitely non-retirement, because we as BlackRock, we do a lot of non-retirement business as well. When there is market volatility, most of our non-retirement business immediately goes to negative, meaning redemptions. You'll see massive redemptions and quite frequently in those very volatile times, if you were to look at BlackRock net sales, especially within the US Wealth Advisory channel that I'm a part of, we see the numbers go from like big positives to very small positives to even negatives, like the net sales, the metric that we measure. On the retirement side, they'll generally stay positive, but there is an impact there. 5 to 9s, on the other hand, it almost never goes negative. Like people who have opened up a 5 to 9 account for their kids' college education or whatever they've opened it up for, they seem to continue to put money into them. And I don't know like what the real reason is for that. And it could simply be because maybe it's not that big a part of their savings to begin with, so they don't want to touch it. It could be because the emotional connection that families have to their own kids' future is a more powerful emotional connection than they have sometimes with their own future self or with their own just not even like the unknown savings that they have. So I would say I can only speculate as to what the reason is. But generally speaking, from a BlackRock perspective, when we look at the data, we do say that 5 to 9s are less sensitive to market and economic volatility.
Yep, and of course, I'm taking Devin's job here. Devin, you want to ask the question from Abba? Because you are the moderator, of course.
Well, yeah, I'm happy to. So yeah, appreciate the question, Abba. So could you please clarify if we're getting more coming in. Hold on. Could you please clarify if college saving employer benefit is already up and running, or is that something that is seen as change to look forward to?
Yeah, and I'll do the quick 2 touches on that one. One is that you're always able to make the contributions, from the employer, channel. There are certain states such as, Colorado and Idaho. I believe there's a total of 6 that do provide, tax incentives, for the employer to make that matching contributions as well. In terms of things that are currently in place and relatively new, in addition to the state tax incentives, there's the more of the the student loan repayment side, and then outlook going forward is the ability to make matches, not just to 401ks, the option to repay, have that match go to pay off student loans, but then also to 529 contributions as well. So it's sort of like where we are, where we've been currently, and where's the outlook. But Tarun, do you want to touch on that one? And then after this one, we'll circle into the next one, Devin, next section.
Cool.
Yeah, no, I think on the employer channel, we struggle with that a little bit from an advisor sold plan perspective. Now, because if you think about the employer channel, like really what happens there is that the financial advisor would have a relationship with that firm. And what that means is usually they'll have a relationship with the senior management, or they may be advising that particular firm for their 401k or similar DC account or something. And then somewhere along the conversation, they might bring up the idea of, hey, you can also offer 529s to your employees, and we could do a payroll deduction, or maybe you as an employer can do some kind of a matching or some kind of income. So all of that sounds good, and it works okay. But I think where it ends up struggling a little bit, if there is an advisor involved, is that in the employer channel, like if it really works, which is what everybody wants. If it really works, then you end up seeing a lot of very small accounts, say 100 accounts, 1,000 accounts, 5,000 accounts, a lot of smaller accounts. And the financial advisor, especially not only the financial advisor, but the financial advisor as well as their own home office, their compliance teams, sometimes struggle to maintain all the monitoring and the suitability and all the infrastructure around making sure that those accounts are being managed. And those can quite easily at least have the potential to very quickly run into numbers that a financial advisor or a financial advisor team cannot manage that easily. So I'm probably saying something which it's a touchy subject. It's something that we sometimes struggle with. So we try to, as a plan, we try to help, and we try to sort of like make the advisors' jobs easier. And we can do that from a servicing perspective. But when it comes to knowing your customer, doing suitability evaluation and recommendations, that is a function that squarely fits with the financial advisor. And sometimes the success of the employer channel can actually work against the success can work against the success, really.
Good work. Devin, do you want to reintroduce the next section? The 2 questions from Patricia can go neatly into the next category.
Yeah, no, that sounds good. So we're gonna Paul and I are gonna change roles here for a bit. So this next section I'm really excited about. This is creating transparency in the 529 space, and Nasdaq's very proud to partner with Blackrock to create transparency in the 529 space. So I'm Paul. I'll pass it over to you, and we can go into the next section.
Sounds good. And before we do, I'll just provide the quick update on the advisors adapting to the industry landscape. I think I tripped up Devin there in terms of the rebutting the last question. Sorry, all my fault, Devin, and for the audience. Yeah, when we did the survey of advisors, there's really three themes that we saw for pros and 3 themes that we saw for cons in terms of from the advisor's perspective. When we did our advisor survey last fall, of 2020 and how it impacted their book, the 3 cons were less ability to meet the client in person, and that's really just advisors needing to adapt to from the in-person to the digital space. The other is that there's just sort of more and more questions around the long-term proposition of in-person schools and education and the implications of cost. Lo and behold, there's a lot of some opportunity for the advisor to educate their clients on the long-term trend of tuition and inflation that's happened over time. So there's some opportunity there for the advisors. The other is the hunkering down mentality that we have heard from some advisors and families as well. More and more people are focused on refilling that emergency bucket that perhaps they didn't even have or properly fund. But lo and behold, that creates the long-term opportunity. Once the emergency bucket's refilled, you can go back to doing goal-based planning more, for retirement and college, and then flipping to the positives. There's just that new message that we're seeing around there about the positive of 529s in terms of being able to be the conduit to help families to really have those educational choices, whether to perhaps go to perhaps a more expensive but more local school, in case of just sort of like that fear context, or being able to afford a more rural school that's farther out of the city. So there's the 529s being a gateway to providing the families with educational options, but also there being more demand for K through 12 options as well. Perhaps the private K through 12s are handling the COVID situation better than publics, vice versa, whatever it may be, just more options. And the last is just being the topics of trade schools. So they're just, and of course the expanded qualified higher educational expenses, providing that opportunity for now trade schools and apprenticeships. But don't worry, Patricia, we'll get your questions at the very end. So we still see it and love the questions. Keep them coming. With that, Angelina, we'll go into the creating transparency section of today's presentation. And we have a question. How familiar are you with Nasdaq Fund Network's 529 ticker transparency initiative? I'm going to say I'll put myself in the category. I understand, but I'm unable to implement, because obviously we're a data research firm. But we'll take a look at the response and see how the responses come out. And as we're waiting for those responses to come in, again, I'll highlight the just my familiarity with Nasdaq, my knowing Nasdaq and working within the custody fund accounting desk for many years, but also just sort of in terms of the feedback we've had from advisors and parents that say like, hey, 529s, they're slightly complex. There's a way to simplify it, just make it easier to do, easier use, just making things more crystal clear. As a quick side note, when I did do pricing, we used Nasdaq as our pricing source. So I was going to that source, frequently, so that, just every day at 3:35 p.m., I would go in and check that for my 20 funds that I priced out. So I think it's a great opportunity to learn more. So the poll has closed. There's 5% saying they understand and have implemented, 3% saying I understand but unable to implement, 23% saying I am aware, will want to learn more to make more informed decision. 62% Devin saying not familiar, but please explain more. And then only 8% saying not applicable. And so with that, yeah, before we go into the question, let's watch a quick video to get more familiar with the opportunity. Thank you.
So Devin, I was expecting to see some dance moves to go with that music.
Yeah, we know each other pretty well, Tarun, at this point, Paul. But I don't know if you're ready for that just yet.
Well, I'm excited to see the 529s in the big lights, and thank you so much. It was great to see the the video. And as a quick side note, once it gets released, I'll be sharing it across our social media. We all get excited here in the 529 space. But for Devin, the first question being, Devin, what are Nasdaq symbols and how do they improve transparency?
Yeah, no, I appreciate that. And then also, Paul, in your previous life before your ISS, we appreciated your business then, and we appreciate your partnership, here today. So, so Nasdaq ticker symbols. So I made mention of this a little bit earlier, when I was introducing Nasdaq. So this is a business at Nasdaq's that we've had for close to 35 years, the Nasdaq Fund Network. We at this point right now, from a 529 registration perspective, we work directly with the issuer. In this case, I'll use Tarun as an example. We worked with Blackrock to register all QSIPs for the Ohio State College Savings Plan. We registered those QSIPs. We customized the ticker symbols. There's 6 characters ending in X. And then we disseminate those out via our outbound data service. So there's really 2 sides to the Nasdaq Fund Network. We have the inbound, where we register the QSIP of the 529, and then we have the outbound, where we disseminate this data to over 400 different platforms and services. So think about Bloomberg, any of Refinitiv or Thomson Reuters platforms, FactSet, Yahoo Finance, Google, all the way down to your Apple Watch. And if you think about it from an investor's perspective, right? So I've got 2 kiddos, a 4-year-old and a 6-year-old. They both have their own 529 plans. If the plan that I'm a part of chose to register those QSIPs with searchable ticker symbols, I, as an investor, would be able to have the same access to be able to see how the 529 investment is doing. Right now, I receive a letter in the mail once a month on how via a paper statement. So our whole goal here is to create that transparency, both for the advisor community and also for the investment community as well too. That's what I would say about that question right there, Paul. Unless you think that there's anything else that I should highlight from a how it works perspective.
Yeah, I mean, from a former operations reporting person, I can personally say that the manually entering prices and then just like the piping in, it's just. Like I think with the transparent, having the ticker symbols will just streamline the reporting both for families, the advisors, and of course then 529s and college financial planning feels like less of a satellite planning auxiliary type of practice, something that's really part of the holistic financial planning, which, as we see in our data and research, college financial planning is part of a holistic kind of picture. So the more uniformity 529s are with the rest of the universe, all the better with that. So that's why I'm excited for it. But on that note, Tarun, we are excited to learn more about why you and Blackrock did partner with Nasdaq as well.
Yeah, no, I would say, Paul, as Devin was saying, I believe that there is a certain beauty in the ability to type a ticker in Google and see the performance history of your investments. Clients like that, and certainly I like that for my own accounts. But from our plan perspective, as an advisor sold plan, there was another equally or probably even more important factor. We, the plan provider, and our distributors rely heavily on the industry plumbing that exists to support the mutual fund industry. For example, some of our broker-dealer partners use the Nasdaq pricing feeds for back office functions such as statement production or trade correction cost estimates. Financial advisors like to see historical performance relative to market conditions to help them make better investment decisions. Even something as simple as placing a trade is easier to do with tickers. And there are workarounds you can use for any of those, but leveraging Nasdaq's plumbing for tickers and price distribution just makes it easier for our clients to do business with us. So that's the reason why we did it. And hopefully that answers your question, Paul.
Definitely does. And I just think that there's so much focus around the ease of doing business for advisors, just make our processes easier. That kind of tails very well with the conversation around the omnibus processing for accounting, just sort of like streamlining all that business and make it easier to do it. And of course, it's great to see the partnership of BlackRock, because there's just a certain thumbs up check mark of approval. It's like, obviously, if an industry leader is doing it, then we're interested in learning about that topic as well.
Sorry, Paul. One other thing I just wanted to mention as well too is, from an advisor sold perspective, and I think that you made mention of this earlier on in the webinar, that it could be difficult for an advisor to really be educated or be able to recommend a 529 plan if they can't look it up, right? And so, it's not necessarily used to recommending these vehicles. So being able to pull up a 529 and be able to pull up a mutual fund and an ETF and stock kind of just puts the 529s on that level playing field. So I also see one other thing I see in the questions. I just saw a question just about cost. The cost, it's $700 a year per QSIP, and that's prorated as well. So we're already saving you money here at February 24th. So it's per share class, and we register at the share class level, and it's completely up to the issuer. How many share classes of a given strategy you would be registering. So,
and as I learned about this new development as well, that the first question I had, and of course the audience does as well, is we look at 529 industry, and there's 600 tickers, and obviously we're going to keep growing up till it's like 5,300 tickers. But is there examples from other like adjacent products, perhaps ITs, mutual funds, ETFs, or is there some sort of other comparables that for this 529 industry, when they go to their board meetings, it's like, here's what happened there, here's what's happening now, and here's where things are going to roadmap probably, or?
Yeah, that's a great question. So one of the first big initiatives that I had when I moved into this role a couple of years ago was expanding the scope of the instruments that we offer, and one of those was collective investment trusts. So I'm not entirely sure how familiar some of the participants here are with CITs, but CITs are pooled investment vehicles, just like a mutual fund. They strike a daily NAV, but they're only for qualified retirement plans. And so CITs have actually been around longer than mutual funds, believe it or not. But over the course of the last probably 3, 4, 5 years, they've begun to come down market into more of like an intermediate advisor-served space. And one of the biggest challenges that advisors face when it came to recommending and even just learning about CITs is because they were so opaque, and not being able to search it at a ticker level. They're familiar with the ClearBridge Large Cap Growth Fund mutual fund, but they're not able to look up the ClearBridge Large Cap Growth Fund CIT R2 share class, if you want to get really technical. So just being able to have that ticker level transparency for the advisor, what we've heard both in the CIT advised space and in the 529 space is really that ticker is that kind of validation point for the advisors. And then I think the last point I'll say is, you just look at the depth and breadth of the platforms and the websites that we connect into. So again, whether you're on Bloomberg or whether you're on Yahoo Finance, that 5-character ticker symbol for the 529 is standardized across all platforms.
Yep. And as we talk about, just awareness and understanding about 529 plans and the need for us to catch up to speed with other products and ideally get farther and accelerate. It's like when I first had the first conversation with Devin, it's like, we need to do this. I mean, we're just, again, behind the curve, and we need to get up to curve. And so we appreciate, your time and insight and insight into that one, Devin. I'm sure we'll be getting questions. Should we pivot over to the question and answer section, or any last notes before we do?
No, I'm good. I'm good on my side.
Sounds good. So the first question is, Devin, when an issuer registers their 529 QSIPs with the Nasdaq Fund Network, can an issuer customize their ticker symbols? Also, once registered, where do these ticker symbols end up being displayed?
Yeah, that's a great question. So yes, the answer is that the ticker symbols can be customized. It's based upon what's available on our side. So the way Tarun, I feel free to speak to this, but I think the way that it worked with BlackRock, for instance, or any issuer that we work with, they say that they have X amount of QSIPs. And then they can send us the recommendations that they would like, or we can generate some ticker symbols that are similar in nomenclature to like the instrument name, or customize at that level. So, Tarun, I don't know if you have anything else on your side that you want to say about that.
I was just going to get really technical on this thing because I think there are Nasdaq rules, and I think there are Nasdaq rules. Could be some other bodies' rules too, but all these ticker symbols, if we're talking about 5 to 9s and mutual funds, the same rules apply. Like they have to end with the letter X. So really, when we're talking about customization, out of the 5, you can pick 4. And as BlackRock, as we were going through that, we actually did customize every single one of the letters, like to the extent that we were able to get availability. So the way we did it, like all of our tickers, where we could, they start with B for BlackRock. And some of the options are iShares, so those start with I. And then the second letter, we customized it based on the actual investment option. The third letter was, I forget what we did with the third letter. And the fourth letter was something that we customized based on the share class. So if it's a share class A, it tends to be A, or C, or I. So we did go through that kind of a very technical, customized approach for the tickers, because at the end of the day, like if you think about tickers, like I'm a BlackRock employee, like within BlackRock, when we talk about our company, when we send an email to each other, we don't say at BlackRock, we say at BLK. Like we're using the market ticker. When I'm talking to my friends over at Bank of America, I don't say Bank of America, I say BAC. So a ticker is like actually a really fundamental aspect of who you are. And the way I like to think about, say, a QSIP versus a ticker is a QSIP is a number. Like, yes, it's an identifier, but it's a number. Like how many times you like call Devin and identify Devin by his phone number. I'm sure some people do that, but generally you know people by their names. Paul does that. Generally you know people by their name. To me, like the ticker symbols are your name. Like if you ask me, like iShares S&P 500, what's the fun? In fact, I would even forget to tell you what the name of my iShares 500 S&P 500 product is, but I could tell you the ticker right away. It's IVV. So I think it's just that's the way we think about tickers. It's really that security's name, and when we were picking the name, we wanted to be very sure of what is the name that we're picking that would represent what our security is, and that's a name that we then use in our marketing material that gets used in our sales conversation. So when our salespeople are on the phone with a financial advisor or however it's working, we start referring to things with their names, with their tickers. That's, I actually lost track of what the question was too. But really, like at the end of the day, like it's because this name will be used in so many different contexts. We wanted to be sure of what that name it is that we're picking, and we customize every single one of those.
Yeah, and that the response ties in very well with a follow-up question that we received. Do issuers have an obligation to register all share classes, or can they pick and choose? I'm just, in terms of my own add-on question to that question is, it'd be kind of interesting to see if people do the A, C, and I share classes, or just like or only certain share classes. I don't know if Devin, do you want to go first and then Tarun, or vice versa? I'll leave it to you two.
I'm happy to go first, and then Tarun, if you want to build on it, you feel free to. Yeah, there is no obligation, and I'll be clear. There's no obligation to register every single share class of your book. It's entirely a la carte. So we register at the share class at the QSIP level, and if you have 100 QSIPs, 100 share classes, and you only want to do 70, that's fine. It's completely the issuer's choice to do that. Tarun, I don't know if you have.
Yeah, I wanted to say like that optionality from my perspective is like a theoretical optionality, because as a plan provider, like we have absolutely no reason to register some and not the others. Like it would be really odd and awkward for us to do it. So when we were looking at this, yes, we were aware of the optionality, but the thought didn't even cross our mind because it would be so awkward.
Sounds good. One other question, circling back to Patricia Roberts, and I'll actually tweak the question to really say, college financial planning is just so important, and it's important for advisors to create a plan and implement the plan. Of course, it's very easy to say, hey, Devin, I'm going to run 5 miles a day, but it's like, it's just great to have there be a coach to say, like, get up, run, eat the right stuff, make sure you're saving, towards the goal at the end of the day. There's always going to be value for advisors in the creation process of a plan, and then just helping clients to execute the plan to save, pay, repay, and of course starting up the cycle again to help families to save and save efficiently. It's just such a big blue ocean issue where it's the top 1 or 2 issue for parents, but so few advisors are having the conversation. Of course, once again, I'm taking Brock Jolly's, statement around their, college financial planning being this ultimate, blue ocean opportunity. Devin, I'm happy you're jumping in to the ocean to help get us up to speed. And, Tarun, of course, you and your team have been a long time pillar within the space. We look forward to the continued partnership. Any other questions, that we've seen come in? Of course, we can, follow up with them after. But of course, I'll see if Devin and Tarun, if there's any particular ones that may jump out to you.
Well, there's one question that I see. It's from James, which is, what percentage of advisor-sold investments have a ticker? I don't remember the answer to it, Devin, but I vaguely remember having this conversation with you. I think we looked at the data, and there was something where we said something like 25 to 30% of the advisor-sold plans. Did I make that number up? Do you remember that?
It's around that. I think it's close. I think it was closer to like 15 to 20%. I can tell you here that we've got just over 700 QSIPs registered today with searchable ticker symbols. That includes the ones that you just registered, Tarun, as well. So that's where we're at today. And I would say that that's among probably 5 or 6 different issuers. Some of those issuers did what BlackRock did and did all, and some have done kind of piecemeal and everything. So, and I've had a couple of discussions with other issuers out there and some ongoing discussions as well. And so I think that a lot of the issuers out there just didn't realize that this was an option. And so I think the last thing I would say from my perspective is I'm happy to connect with anyone following this call on being a resource, and obviously our partners at ISS Media and Paul would happy to connect you with me as well, and look forward to being a resource for everyone.
That's good. I think 6 to 7 plans is about 20% of the industry, advisor-sold industry.
Yep. And, for a lot of these sessions, I like to kind of close with a final statement. And, I guess I'll go first and just say that, it's so critical for us to get up to speed. That the need for college financial planning has not slowed down. In 2020, the student loan debt number, continued to go up. The need to save and pay for college has only gone up. The education being the main driver for higher income, lower unemployment, and better ability to, more likelihood to telecommute and have a better lifestyle and life for yourself and your family has only gone up. The need for education has increased. The overall planning has stayed flat. So there's a huge opportunity for advisors to step in. So many different ways that we can accelerate and grow this industry. Devin, I'm happy that you're jumping in to help get us to where we need to be. And, with that, I appreciate the time. And Tarun, what's your final statement? And then we'll go over to you, Devin, for the final word. My final statement is I just want to thank you, Paul, so much, and Devin and everybody else for joining in. And I want to also give a shout out to Paul, your marketing team, Angelina, and everybody who's put this together. I know there's a lot of work that goes behind putting something like this together, and I'm a beneficiary. I'm happy to be able to participate in something like this. So thank you, everyone. Thank you, Drew.
Yeah, and I think I definitely echo those sentiments. I appreciate the ISS marketing team. Angelina, you and your team did a great job here. Thank you to the Nasdaq marketing team as well too for helping coordinate. And our entrance into the 529 space we're really excited about it. This seems like a really great community with a very common shared goal that I think is aligned with Nasdaq's vision as well. So I look very forward to being able to meet the rest of you once we can start getting out of the house a little bit more. But it's a privilege to be a part of this today, Paul. We sincerely thank you from Nasdaq. Tarun, you're a great partner, and we look forward to continued partnership. So appreciate it, and cheers.
Thank you, Devin. Contact information here. Please complete the post-event survey. There's going to be an email out to this event. And thank you so much for your time and effort today. Have a great one.
Take care.
Thanks, everyone.